Okay, so you know the quote. Never get involved in a land war in Asia. And of course, never go in against a Sicilian when death is on the line.
Vizzini, The Princess Bride. A classic. I have a feeling I know where this is going.
It's just timeless advice. But looking at the headlines this morning, specifically around the Q4 earnings reports, I think we have to add a third classic blunder to that list.
And this one, I'm guessing, involves a clown and some French fries.
Never get into a price war with McDonald's.
That is a very, very expensive lesson. And a lot of their competitors are learning it the hard way right now.
So today we are diving deep into the golden arches. It's February 15th, 2026. McDonald's has just dropped their Q4 2025 earnings. Their whole 2026 strategy is out. And, well, the numbers are just defying gravity.
They really are. Especially when you look at the rest of the restaurant sector. It's a fascinating case study in resilience.
Yeah, we're talking about a behemoth, a market cap of what, $233 billion, stocks trading around $327. And while other chains are, struggling, McDonald's is basically printing money.
They are. And I think our mission today is to figure out the how, not just, applaud the numbers on the scoreboard, but how does this legacy brand lean into a value environment, which usually just means razor-thin margins, and at the same time plan this incredibly aggressive expansion.
Oh, that expansion into China, we have to get to that because those numbers are just mind-boggling. And of course, the big question for everyone listening, is the stock a buy right now? Because despite all this success, not every analyst is convinced.
Right. Is it a real growth story, or is it just a safe place to hide?
Let's start with that blunder. The price war. Our source material, Jeffrey Seiler's analysis, calls it a value victory. But usually when I hear price war, I just think desperation, slashing prices, killing your bottom line. How is McDonald's different?
Well, they're not totally immune, but they are incredibly insulated. It really boils down to two things: scale and their franchise model. You have to remember, McDonald's isn't really a burger company.
Right, the old, we're actually a real estate company line.
It's a cliche because it's true. I mean, think about it. When consumers get nervous about money, they trade down. That $20 fast casual bowl becomes a $5 meal deal. McDonald's just soaks up all that volume.
Okay.
But here's the key. Unlike a smaller chain, they own so much of the land under their stores. They're collecting rent from franchisees, whether beef prices go up or down. It gives them this revenue floor that competitors just don't have.
So when a competitor tries to match that $5 deal, they might actually be losing money on it.
There might be bleeding cash, yeah. Whereas McDonald's, with their supply chain, they're negotiating rock-bottom prices for potatoes, for beef. They can sell cheap and still make a margin. It's a war of attrition, and they can just hold their breath longer than anyone.
And it's not just about being cheap. They've weaponized their marketing. We have to talk about the socks.
I was wondering when we'd get to the Grinch socks.
I can't get over it.
Yeah.
It's the weirdest and maybe the most brilliant stat in the whole report. A huge driver of U.S. sales in Q4 was a Christmas promotion, the Grinch Meal.
It sounds so silly. But as a business strategy, it's genius.
The source says they sold more than 50 million pairs of Grinch socks. 50 million.
50 million.
That's like the entire population of South Korea deciding they need fuzzy green socks with their burger.
And think about what that means. It's 50 million transactions. People came in for the socks, which are a high-margin little piece of merchandise, but they stayed and bought the food. It completely changes the value calculation.
How so?
Because you're not just thinking, how many calories am I getting for my dollar?
Yeah.
You're thinking about the entertainment, the collectible. It creates this sense of FOMO, fear of missing out. So that $5 meal feels like a steal because you're also getting this fun piece of pop culture.
It's just the Happy Meal strategy for grown-ups.
That's a perfect way to put it. And it wasn't just the Grinch. They brought back the Monopoly game. They relaunched their whole McValue platform.
Right, the $5 deals and the extra value meals.
Exactly. Socks get you in the door once, maybe twice. The McValue platform makes you come back every Tuesday for lunch. It builds a habit. And that habit is what we're seeing in these Q4 numbers.
Okay, so let's pivot to those numbers. Socks are fun, but Wall Street wants the data. And the data is, well, it's pretty heavy.
It was a very substantial beat across the board.
So revenue hit $7 billion. That's up 10%. Even if you account for currency changes, still up 6%. The estimate was, what, $6.84 billion? They blew past it.
And for a company that matures, that's a huge deal.
Yeah.
You usually see them beat or miss by, a fraction of a percent. A beat like that means they're actively taking market share.
And the bottom line, EPS, earnings per share.
Hit $3.12, up 8%. Also beat the estimate of 305.
But you always say the real truth serum, the number that shows the true health of the brand, is same-store sales.
It is. Because, look, you can always grow revenue by just opening more stores. That's just spending money. Same-store sales tells you if your existing restaurants are getting busier, is the core business healthy?
And globally, that number was up 5.7%.
Yeah, when analysts were only expecting 3.9, that is a massive, massive beat.
The U.S. was even stronger, up 6.8%.
That's the Grinch effect. That's the value menu. I mean, it could grow almost 7% in a totally saturated market like the United States. It's incredible. It just shows you that the American consumer is feeling the pinch, and they are voting with their wallets for McDonald's.
Which is so interesting because usually after a quarter like this, the guidance is all sunshine. But management actually poured a little cold water on Q1 of 2026.
They did. They warned that the growth in Q1 will be softer.
And the reason they gave was the weather.
It always sounds like such a lame excuse, doesn't it? The dog ate my homework. It really does. Oh, sorry, it snowed, so we missed our numbers.
But in this case, it's probably true. I mean, January was just brutal in huge parts of the U.S. If the roads are icy, you're just not making that extra trip for a McFlurry. It's not a flaw in the business.
So as an investor, I shouldn't panic about that.
No, not at all. You look right past it. Weather is temporary, it's external. The underlying demand, what they call brand heat, that's clearly still there.
Okay, so forget the snow. Let's talk about something we cannot ignore. The 2026 expansion plan. I saw this number in the source material, and I actually had to read it twice.
The unit growth, yeah.
It's
ambitious. Ambitious. They plan to open roughly 2,600 new restaurants this year.
It's a major acceleration of their strategy.
I did the math on this. That is about 7 new McDonald's opening their doors every single day for a year.
It's staggering when you put it like that.
My question is just, where? I feel like you can't swing a cat without hitting a golden arches. Where are they putting all these new stores?
And this is where the strategy pivots. It's not about the U.S. anymore. It's about global growth. So of that 2,600, only about 750 are in the U.S. and their other, core international markets.
Okay, so where's the rest?
The lion's share, 1,800 stores, are going into what they call licensed markets. And the source specifically calls out China.
Right. 1,000 of the new stores are planned for China. In 1 year.
1,000.
That's the land war in Asia we were joking about.
It's a burger war. And they are going all in.
Okay, help me understand this. We're always reading about tensions with China, about their economy slowing down. Why would you double down so hard right now?
It's a calculated risk, but it's a bet on demographics. Yes, the Chinese economy has slowed, but just like in the U.S., that actually pushes more consumers toward value brands. And more importantly, this expansion isn't about Shanghai and Beijing. It's about the Tier 3 and Tier 4 cities.
So places where there isn't a McDonald's on every corner yet.
Exactly. They are racing to plant their flag, to lock down the best real estate before local competitors can. It is a genuine land grab.
But that feels like a huge risk. What if there's a nationalist backlash or something? That's a lot of capital to put into one country.
It is an immense risk.
Yeah.
But you can't get to their goal, 4.5% unit growth, by just building more stores in Ohio. You have to go where the people are. And remember, most of these are licensed.
So local partners are putting up the money?
A lot of it, yeah. McDonald's provides the brand, the playbook, the supply chain. It de-risks it for corporate while still giving them that sweet, sweet royalty income.
That is smart. And they're not just building new stores, they're changing the menu. It looks like the focus for 26 is chicken and beverages.
The two holy grails of fast food profit margins.
The chicken sandwich wars. I feel like we've been talking about that for years. Is that still a thing?
It never really ended. It just became the new normal. Chicken is cheaper than beef. Consumers like it. And for McDonald's, the margins are just better.
And the fancy drinks, the coffees and lemonades.
That is pure profit. I mean, it's just water, syrup, and ice. It costs them pennies to make, and they can sell it for $3-4.
Yeah.
It's the most profitable part of the whole restaurant.
So if they can get you to buy a chicken sandwich and a specialty coffee instead of a Big Mac and a water...
They win. That's the whole algorithm right there.
Okay, so let's recap. They're winning the price war, they're crushing earnings, they're expanding like crazy. It sounds like a total slam dunk.
You would think so, wouldn't you?
But this is where the story gets tricky. Let's get to the verdict. The author of our source, Jeffrey Seiler, is very bullish, but The Motley Fool's stock advisor team, they kind of snubbed McDonald's.
Snubs is a good word for it, yeah. McDonald's did not make their list of the 10 best stocks to buy now.
And this is a list that, historically has picked monster stocks like Netflix or Nvidia way before they exploded. So what gives? If McDonald's is doing so well, why isn't it on the list?
It really all comes down to what you're looking for as an investor. The stock advisor team, they're hunting for what they call multi-baggers, stocks that can, double or triple your money. They want hyper-growth.
And a company the size of McDonald's just can't do that.
It's a massive ship. It's an aircraft carrier. For a $230 billion company to double, it has to create another $230 billion in value.
Yeah.
It's just incredibly difficult to do that quickly.
So it's a speedboat versus an aircraft carrier.
That's the perfect analogy. The speedboat can go 0 to 60 in a flash, but it could also flip over. The aircraft carrier just keeps steadily moving forward.
So what about the valuation? Is it expensive for an aircraft carrier? It's trading at a PE ratio of just under 25?
Which is, historically, pretty full. It's not cheap. But in this kind of market, you're not paying for explosive growth. You're paying for certainty.
You're paying for the fact that they're not going to go bankrupt in a recession.
Exactly. You're paying for that dividend, which is over 2%. You're paying for the share buybacks. It's the definition of a blue-chip defensive stock. If you think the economy is going to be shaky, McDonald's is a great place to be. It'll probably beat the market.
But if the market rips higher and tech stocks are up 30%?
Then McDonald's will probably lag. That's the trade-off. It's for stability, not for getting rich overnight.
So the verdict really depends on who you are.
Completely. If you're a 25-year-old trying to grow a small portfolio, this is probably too slow for you. If you're 55 and you want to protect your capital and get a steady dividend, it's a cornerstone of your portfolio.
That makes perfect sense. It's about what your own mission is.
And the author? Seiler, he clearly believes we are staying in this value environment. And if that's the world we live in, a world where everyone's hunting for a bargain, McDonald's is king.
Which brings me to my last thought here. I want to zoom out. We've talked about stocks, China, PE ratios, but what does it say about the world that maybe the most confident, aggressive growth story for 2026 is McDonald's?
It's a very telling signal, I think.
I mean, if the smartest people at McDonald's have looked at all the data and decided the future is selling $5 meal deals, are we entering what you might call a golden age of thrift?
It certainly points to a big shift in the global consumer's mindset. For a decade, the story was premium everything. Premium phones, premium cars, premium coffee. McDonald's betting the farm on value suggests they see a long-term trend of consumers trading down, not just here, but everywhere.
It's almost like a defensive posture for the entire global economy.
Or maybe just a return to basics. The era of 0% interest rates is over. Inflation left a mark. McDonald's is just positioning itself to be the utility provider of calories for a much more budget-conscious planet.
The utility provider of calories, that is beautifully bleak.
But probably pretty accurate.
Well, on that note, I think I need to go check my own budget. And maybe see what those Grinch socks are going for on eBay.
Honestly, that might be the better investment.
Better than the stock.
If they become a collector's item. You never know.
I'll take my chances. This was great. Thanks for breaking down the golden arches with us. It's way more complex than you'd think.
My pleasure.
And for all of you listening, whether you're holding the stock or just a quarter pounder, thanks for diving deep with us. We'll see you next time.